What are externalities? In economics, an externality is a side effect, good or bad, of one person's or firm's action that spills over onto others and is not fully accounted for in market prices. When your decision imposes costs or benefits on bystanders who aren't part of the transaction, we say there's an externality. Negative externalities, like pollution, push private activity beyond the socially efficient level. Positive externalities, like herd immunity from vaccines, lead to too little of the activity relative to what's best for society. A quick history. Arthur Cecil Pigou, 1920, formalized the idea that when private marginal cost, or benefit, diverges from social marginal cost, or benefit, markets misallocate resources. His remedy, Pigouvian taxes and subsidies, aims to align private incentives with social outcomes by pricing the external effect. Ronald Coase, 1960, added a crucial twist. If property rights are well defined and negotiation is costless, parties can bargain to internalize the externality without government setting a tax. What often blocks this solution are transaction costs, coordination problems, legal fees, free riding, or simply too many affected parties. Modern work blends both insights. Choose instruments that minimize the sum of abatement costs, information burdens, enforcement costs, and unintended consequences. How it works in practice. Think of a factory that emits smoke. The firm's private marginal cost excludes the health damage to neighbors. The social marginal cost is higher. A Pigouvian tax, set equal to the marginal external damage at the efficient quantity, makes the firm see the harm in its bottom line, reducing emissions to the socially optimal level. When damages vary by time or place, cap-and-trade systems, or differentiated charges, e.g., congestion pricing at rush hour, can target where harm is greatest. For positive externalities, say basic R&D, subsidies, prizes, or intellectual property protections can raise the private return toward the social return. Important distinctions help avoid confusion. A technological externality directly affects others' production or utility, smoke, noise, knowledge spillovers, and can cause inefficiency. A pecuniary externality works only through prices. Your bid raises house prices I pay, which generally does not create inefficiency in competitive markets. Also, public goods, non-rival, non-excludable, often involve externalities, but the concepts are not identical. Fireworks displays are public goods. Your backyard bonfire's smoke is a negative externality. Classic examples: pollution and congestion, emissions fees, low emission zones, or tradable permits price harm. Congestion tolls price scarce road space when it's most valuable. Network externalities. A phone network or social platform becomes more valuable as more users join. Early subsidies or interoperability rules can help reach efficient scale without locking in inferior standards. Knowledge and education. Your training can boost co-workers' productivity. Matching grants for education or R&D tax credits aim to close the gap between private and social returns. Health externalities. Vaccination reduces disease spread. Subsidies, mandates, or no jab, no entry rules combine price and regulation to internalize benefits. Design pitfalls and tips. 1. Measure the margin. Taxes should target marginal harm, not average harm. Blunt rules risk over or under correction. 2. Beware leakage and rebound. Tight regulation in one area can shift emissions elsewhere. Leakage. Efficiency gains can increase use. Rebound. Complementary policies, border adjustments, usage pricing can mitigate this. 3. Mind administration. When monitoring is hard, consider liability rules, performance standards, or deposit refund systems, e.g. bottle deposits, that are simpler to enforce. 4. Use Coasian tools where feasible. For local small-n problems, your tree shading my solar panels, bargaining, mediation, or clear property rights can beat complex taxes. A couple of curiosities. Coase famously challenged the textbook tale that lighthouses prove markets can't provide public goods, Historically, many were privately financed via port fees, showing that institutions matter, and beekeepers and orchard owners illustrate a cheerful, positive externality. Bees pollinate fruit trees, trees feed bees. Tailored contracts, or co-location, can internalize the spillovers without a subsidy. Above, I've left more videos to keep learning law. Remember to leave us a like and subscribe.